Today we're going to take a look at 5 AI stocks that are very undervalued. We're going to start this video out with a very simple way to see if a stock that you're looking at is overpriced or undervalued. I use the PE ratio, which is the price to earnings ratio. So the PE ratio is the current stock price divided by the earnings per share. And obviously, the lower the number, then the more undervalued it's going to be. Like Palantir has been on a huge hot streak lately, but the PE ratio for Palantir is over 200, which is ridiculously high. So the interpretation of a PE ratio suggests that investors are expecting higher earnings growth in the future. They are willing to pay more for each dollar of current earnings because they anticipate those earnings to increase significantly. This is often seen in high growth industries like technology. A low PE ratio might indicate that the stock is undervalued or that investors expect slower earnings growth in the future. It could also mean the company is mature and has been stable and has stable but not rapidly growing earnings. So the stocks that we're looking at today are AI stocks, which generally are going to be high growth, but they're going to have lower PE ratios. Okay, the first stock we're going to look at today is Google. Believe it or not, Google has a 17.6 PE ratio. Google is spending a lot of money in the AI space, and they're doing a lot with Gemini and I guess their new program, which is called VO 3. So if we take a look at Google's financials, their latest earnings for Q1 was 90.23 billion, which is up 15% year over year. And their earnings per share was $2.81, which is an impressive 62% increase year over year, beating estimates by 80 cents. Crazy. Google Cloud revenue is 11.35 billion, and that's a 28% year over year rise, exceeding expectations. Okay, let's take a look at the Google chart. On this channel, we're always going to look into the fundamentals as well as the technical analysis to see where the price is currently. Currently, it's kind of in the lower mid of the range. The range for the daily is between 140 and 207, which is a wide range. But it's been up to 207 as recent as February, and it's gotten down to $140 as recent as mid-April. So I think it's in a good spot. And obviously from the fundamentals and the PE ratio, it's looking like this is an undervalued stock. The second AI stock that we're going to look at that I'm considered undervalued is Meta. You're going to be like, no, that's not undervalued. It's $647. But according to the numbers, the ratios, the earnings per share, everything, it is undervalued. The PE ratio is a little bit higher than Google at 28.1, but it's still indicating that it is undervalued. The revenue is 36.46 million, or billion, I should say, with a B, up 27% year over year. And the earnings per share increased 73% year over year, surpassing the estimates of 432 at 471. And an operating margin is 38%, which is improved from 25%. Let's quickly look at the chart. The chart's kind of in the middle of a range between $740 and $479. I think it's still in a good spot. So Meta is my second AI undervalued stock. My third stock is AMD. This stock for some reason gets a lot of hate. I think this was going to do well in 2025. Their earnings were pretty good. So the earnings per share were 62 cents, a 3% year over year increase. And data center revenue was an 80% year over year increase. I think the reason that people hate this stock is they don't understand it. They don't understand what it does and how many different things it does. Uh, AMD's Instinct MI350 GPUs and its partnership with TSMC are driving AI chip growth. Analysts predict 51% earnings growth in 2025, which would be huge, with a price target of $148.34. Let's take a look at the price currently. Price of AMD is at $111.51. The crazy thing about AMD is it's been up to over $227 in recent, that's pretty recently, that's a year ago. I think this stock has a lot of room to run. Like I said before, it does a lot of different things that people don't really understand besides GPUs. It does a lot with data centers, cloud computing, in the automotive industry, also machine learning, and generative AI. So there's a lot more to AMD than just GPUs. So I think AMD has a very bright future. I think it can run up to $200 or more in the next year or two. The next undervalued AI stock is Taiwan Semiconductor Manufacturing. This one's a little bit tricky because of the geopolitical tensions in Taiwan and trade tariffs that are going on currently. The PE ratio for TSM is currently 25.25, and the revenue is up, and the earnings per share is up 8.9% year over year also. This one is also kind of in the middle of the range at 192.5 currently, and it could get up to 226 pretty easily. There's not much resistance there. There's like literally no resistance until 210, and then if it got over 210, it would probably go all the way up to 226. And all that would need to happen would be some clarity on these tariffs. Right, last but not least is SoundHound AI. This one is very interesting. Currently, their PE ratio is 20.98. The revenue is a remarkable 151% year over year growth at 29.1 million. SoundHound's voice AI platform is utilized across several sectors, including automotive and healthcare. They've expanded its reach and revenue growth of 151% year over year, significantly outpaces competitors. Price target is $12, which is 25% up from where it's at now. Let's take a look at the price. The price currently is at $10.09. It's way under the high of $24.98, which happened in December of last year. So this one out of the five is at the bottom of the range. So it's got the most upside, but it is the most risky because the market cap is smaller. If there is an AI stock that you like, please leave those in the comments. If you would like for me to do more of these lists in the future, please leave that in the comments as well. Please subscribe, like this video. Thank you for watching, and have a great day.